If you're thinking about buying a home, one of the first steps you'll need to take is to get pre-approved for a mortgage. This process involves submitting your financial information to a lender, who will review it to determine how much money they're willing to lend you and at what interest rate. Here are 5 things you need to be pre-approved for a mortgage. 1. Good credit score. One of the most important factors that lenders consider when reviewing your mortgage application is your credit score. Your credit score is a numerical representation of your creditworthiness, based on your credit history. Lenders use this information to determine how likely you are to pay back the loan on time and in full. Generally, a credit score of 700 or above is considered good, while a score of 620 or lower is considered poor. The better your credit score, the more likely you are to be approved for a mortgage and to get a favorable interest rate. 1. Steady income. In addition to your credit score, lenders will also look at your income and employment history when deciding whether to approve you for a mortgage. You'll need to show proof of steady income, such as pay stubs, tax returns, or bank statements. Lenders will also look at your employment history to make sure that you've been employed consistently for at least 2 years. If you're self-employed, you'll need to provide additional documentation, such as tax returns and profit and loss statements. 1. Down payment. Another important factor that lenders consider when reviewing your mortgage application is your down payment. The down payment is the amount of money you'll need to pay up front when you buy a home. Generally, lenders require a down payment of at least 20% of the purchase price of the home. However, there are some mortgage programs that allow you to put down less than 20%, such as FHA loans or VA loans. Keep in mind that the more money you put down up front, the less you'll need to borrow and the lower your monthly mortgage payments will be. 1. Low debt-to-income ratio. Your debt-to-income ratio, DTI, is another important factor that lenders consider when reviewing your mortgage application. Your DTI is the percentage of your monthly income that goes toward paying off debt, including credit card balances, car loans, student loans, and other debts. Lenders prefer borrowers with a low DTI because it shows that you have a good balance between your income and your debt. Generally, lenders prefer a DTI of 43% or lower, although some lenders may allow a higher DTI if you have strong credit and other compensating factors. 1. Proof of assets. Finally, when you apply for a mortgage, you'll need to provide proof of assets, such as bank statements, investment account statements, and retirement account statements. Lenders want to see that you have enough money in savings and investments to cover your down payment, closing costs, and other expenses associated with buying a home. Having a strong financial profile with significant assets can also help you qualify for a larger loan amount or a better interest rate. In conclusion, if you're planning to buy a home, it's important to get pre-approved for a mortgage before you start shopping. To be pre-approved, you'll need to have a good credit score, steady income, a down payment, a low debt-to-income ratio, and proof of assets. By taking the time to prepare your financial profile before applying for a mortgage, you can increase your chances of getting approved for a loan with favorable terms and a monthly payment that fits your budget.